I basically am saying that the inflation is trending down. It may have stalled a little bit here. It may get sticky here, but basically I think we're trending towards ultimately deflation if I'm right that we're heading for a global bust. I think we may already be in recession, and if we're not, that will only be known when they go back after the fact and date the recession. So I'm not saying it'll be obvious in the next month, but we could be there already, and if not, we are definitely slowing. And so if the economy is slowing, I think it's going to keep inflation pretty much under control until it rolls further down when the economy really takes a dip. Frankly, people don't talk enough about the fact that we have crude oil at $63 a barrel, down from high 80s, and certainly, just more recently, it bounced up from 55 to the mid 70s because of Iran, but it's right back down into the low 60s. So I think gasoline and oil are going to help keep inflation moving down, not up. And, I think the economy is trending down, and I think those are much more important stories than, month-to-month data. My view has been and continues to be that the economy is moving towards recession, and that because of the leverage in the system, which is beyond anything we've had in any previous cycle, so far beyond 2008-9, far beyond 2020, we're looking at 330 trillion in global debt. We're looking at quadrillions in notional value of derivatives. So I describe the debt as a leverage on the financial system, leverage on the economy, and derivatives as the leverage on the markets, fixed income, equity, metals, everything. There's so many derivatives out there. And people don't realize we really didn't have derivatives before the mid 80s or late 80s. So we've just exploded in terms of kind of a tail wagging the dog in a lot of ways. With that leverage in both on the system and on the markets, I believe this is going to be far bigger than 2008-9. So as I say, 2008-9, we almost went over the cliff, but when the commercial paper market froze and GE almost went under, our policymakers acted just in time and kind of pulled us back from the edge of the cliff. We had a rough, what they call a Great Recession, but we didn't go over the cliff. I think this time the potential is there for us to go over the cliff, meaning I call it global bust, but basically meaning something that leads to lots of bank failures, big bank failures across the globe, probably more so overseas than the U.S. this time, because our banks were forced to clean up their act and get unlevered, deleverage a lot. So they're still vulnerable, and certainly the counterparty risk means that if something happens in the big banks in Europe or over in Japan, our banks are in trouble too. But that's my thesis, just very simply, the leverage this time around could take what would have been an ordinary recession and turn it into something greater. I define a bust as something that'll feel like a depression but not last for more than 12 to 18 months. So the unwind will happen very fast relative to what a depression is, but it will come with a lot of pain while you're in it. I think the stock market can drop as much as 80% peak to trough. So people have a hard time with that part of my forecast now, because obviously we are nowhere near that. Question whether we're even going to see a recession. I think right now you can get a very long extension or steep extension to the bull market, because I think there's enough buoyancy in the market to allow particularly institutions to believe it's a soft landing. But I believe it's going to be a hard landing starting next year. Could even begin by the end of this year. I think, as we saw in 2008-9, when things tip over, they can get pretty ugly pretty fast. So you have to be careful not to be lulled to sleep. I remember September of 2008, I was calling for a hard landing, and I had no company. The vast majority of economists on the street were saying soft landing, no recession in sight. That was 3 weeks from Lehman Brothers. So things can happen fast, particularly in the financial world. You can think everything's kind of, not that it's great, but it's not bad, and then go from soft landing to hard landing expectations in a hurry. So I don't know if we'll see it that quickly, but that's kind of my guess, is that next year is going to be the bust. I'm calling for this parabolic melt up into a top first. So probably since we last talked, I've raised my targets at least twice. I'm at 8,700 on the S&P this year, 30,000 on the NASDAQ, 60,000 on the Dow, and 3,400 on the Russell. So if you do the math, basically low 30% gain from here on the S&P, mid 30s gain on the Dow, about a 40% gain on the NASDAQ, and a 50% gain on the Russell. So, and I'm saying that will likely happen this year and maybe by early fourth quarter even. So I think it'll go parabolic and we'll cover a lot of that ground in a hurry. So the others have been bearish for a while, and I think are bearish on the market and have really been, as has the street, been skeptical of the market all the way up here. I'm still the bull on the street, the high guy on the street, but at the same time, I'm also probably have one of the more severe bearish calls. So just as a preface, that's, kind of, it's not straight to bust. And the reason you can have that is what I said before. I think for at least the next few months, you're still going to have the look of a soft landing. And frankly, I'm bullish on bonds, bearish on rates. So I think in the next 2-3 months, you could have rates down well under 4% on the 10-year. And that's going to help housing temporarily, probably help autos, help retail a little bit. So that can give you some of that soft landing look too, is that you're getting some support from lower rates. But then ultimately, I think we are trending towards a recession. That recession then moves towards a bust. So what am I looking for in terms of triggers for the bust? Let me step back and say it's not so much a catalyst for the bust, but what gets us to that bust is that leverage plus central bank policy error. I think the Fed in particular, but really around the globe, there's this tendency to worry about the last war. They're still all worried about inflation heating up again. So it's going to keep them from, and not repeating the 2008-9 policy. So it's going to keep them, when things start rolling over, there's going to be a reluctance to print money. Powell's already stated, we're not going back to QE infinity. We're not doing that again. We're not here to support the markets. We're looking at the economy with a dual mandate of inflation and jobs. And, payroll numbers are still okay. They're starting to weaken, but they're still okay. I'm saying this is what Powell's saying. And inflation, we're worried that the tariffs could push up. So they're going to be slow to respond to what is an economy that's softening, I think. And then as we get more clarity on the softening, they're going to be very timid in what they do. The normal response of saying, hey, things are starting to get ugly. We got to print, a couple $1 trillion. As we know, they did $5 trillion in 2020. Their plan is not to do that again. If you ask Powell today, and he was on a lie detector, are you going to ever go back to printing trillions of dollars? He would say no. I think, and be very sincere. There are people who think he knows what I'm talking about. No, they truly believe we can't go back there. Now, that'll be different when they finally recognize that they have to do more than they thought. It'll be too late. They're going to be slow stepping the early part of the recession and then the early part of the bust. And they're only going to get to what I call, it's not just, unfortunately, a lot of people on the street, you're either, and certainly retail investors are this way, you're either easing or you're tightening. You're either easing or you're not easing. It's also a matter of right size policy. And I have said for quite a while now, given the leverage in the system and what I think is coming, and again, it's global, I think it could be as much as 20 trillion coming out of the Fed to stop the free fall and turn it around. So we did 3.5 trillion, let's say, in response to 2008-9, over the course of the next several years, QE 1, 2, and 3. And then we did 5 trillion in the pandemic. So that got us up to a $9 trillion balance sheet. We were only at 875 billion going into the 2008 slide. So we went from 875 billion in 2008, fall of 2008, to 9 trillion, 15 years later or whatever. And now we've shrunk it back to, say, 7 trillion. I believe you'll see us up near 30 trillion in response to the bust. But the first half of that bust, they're going to be slow walking it and thinking, yeah, we did $1 trillion. Oh, we did a couple more trillion. They don't realize, because they have never, this is going to be unprecedented. We've never unwound like this before. 2008-9 was the closest. And it's going to take them a while to realize, you do $1 trillion and you wait a couple weeks and nothing's happening good. You do another couple trillion. And it'll take them several months to get to a right size policy. In the meantime, markets are free falling. Banks, are going under. We're seeing a lot of involuntary debt liquidation. We've got so many areas out there where we talk about the leverage and we talk about, I mentioned the numbers on debt and derivatives, but it's also look at what that means. It means all that private equity that's basically leveraged buyouts, all the pension funds that have loaded up on private equity because it didn't have the volatility that the market had. You've got a lot of those things that have kind of come into play in this cycle and have never really been fully tested. So I think you're going to see a very violent unwind that, I think the bear could go from peak to trough in 8 to 10 months. The bust could be over in 12 to 18 months. So it's not that it's going to be long lasting, but while we're in it, it's going to feel like an eternity.